global backdrop is shifting from rising global price inflation to tariffs and geopolitical anxiety, to shifting trade dynamics and worries about growth. Here in South Africa, structural fragility persists, from logistics bottlenecks to tepid consumer confidence. At the same time, the South African Reserve Bank is recalibrating, a subtle yet momentous shift toward the lower bound of its inflation range. Interest rates are falling, but with caution. Growth remains sluggish, with policymakers again downgrading projections and bracing for US tariff impact. This is no ordinary Wednesday, Investec's flagship podcast that goes beyond the headlines into the ideas shaping business and finance. A very warm welcome. I'm Jeremy Maggs. In this episode, I'm joined by Investec Chief Economist Annabel Bishop, and together we're going to discuss and dissect the shifting sands of macroeconomic policy, from inflation anchoring to interest rate directions, GDP trends, tariffs, and the fortunes of both consumer and the rand in a capricious global environment. Annabel Bishop, welcome back to No Ordinary Wednesday. So, Annabel, let's begin with South Africa's inflation targeting. The Monetary Policy Committee, as we know, recently lowering the repo rate, but perhaps more significantly stated it's going to focus on the bottom of the 3 to 6% target, explicitly favouring 3%. So maybe give us a sense of what is behind this shift, and is it or not going to result in significant rates cuts?
Yes, hi Jeremy. There are a number of factors at play here, one of which is that South Africa's inflation rate is actually already at the 3% mark, and indeed has been below 3%, as many know, for quite a while now. So the Reserve Bank, in a way, is looking to make hay while the sun shines. Now, of course, if we unpack why is the inflation rate so low, before we get to the South African Reserve Bank's inflation, South Africa has faced both weak demand, but also very low statistical base effects. As you know, those fade, statistical base effects, and in fact, we're going to be moving into higher effects later this year. In other words, inflation is probably going to rise towards 4%, but then it could drop back down next year. I think really what the South African Reserve Bank is seeking to do is to try and lock in inflation expectations at a lower rate. That is, inflation expectations at a 3% rate for CPI inflation as opposed to 4.5%. Now, of course, there's been a lot of discussion around this, and of course, one of which is, will inflation expectations settle around 3%? If they do, then the South African Reserve Bank's job is done. It's not without the bounds of what National Treasury has set for it. National Treasury has said that inflation needs to run between 3 and 6%. Originally, when inflation targeting came in the 2000s, inflation targeting, as you would imagine, focused on the 6% and just below mark to try and obviously get inflation down. Many years passed, and of course the Reserve Bank moved to 4.5%, and now it's moving to 3%. So from this perspective, there's a positive outcome in that on a longer term basis, we could see lower interest rates in South Africa. The reason why that is that the neutral interest rate in South Africa is really seen as 2 to possibly 2.5% higher than inflation. So if we're looking at an inflation rate of 3%, one would anticipate that we would therefore find that we're in a situation where our repo rate could be at 5%, as opposed to if inflation was at 4.5%, you might be looking at the 6.5% to 7% repo rate. So that's really where a lot of this comes from. Now, of course, we're probably going to see a bit of a jump towards the end of the year. It doesn't mean we might not get another interest rate cut this year. We could well get another 25 basis point cut. We think it might well come at the September MPC meeting. Now, as we move into next year and we get past that move towards 4%, then we could start to see inflation sink back down again if expectations become entrenched, allowing for further interest rate cuts. And of course, that's where the South African Reserve Bank talks about we actually could see maybe a full 1% cut next year. So things could be exciting. We could see movement in this direction, but it all comes back to inflation expectations. Do people start to negotiate on a 3% increase for salary and wage increases in the public sector, the private sector, escalation rates, other areas, even National Treasury itself in terms of it looking forwards in terms of, what increases are going to be on expenditure? Or do we start to migrate back towards the 4 to 4.5% mark?
So what would key triggers be then, Annabel, for either accelerating or pausing cuts?
So, Jeremy, as you know, South Africa doesn't operate in isolation. We obviously are greatly influenced by what happens in international financial markets, particularly in the United States. And of course, interesting, recently, we actually saw financial markets pull back on the expectation of a cut in United States interest rates in September. So when the US cuts interest rates, that tends to bolster our rand. And interestingly, that's also an area as well the South African Reserve Bank talks about in terms of its inflation targeting, that it believes will see a significantly stronger rand when inflation expectations settle around the 3% mark as opposed to the 4.5% mark. So the rand really coming into play here as a key point. And, that's really because inflation in South Africa is actually determined as well by what happens in terms of our exchange rate. If the rand tends to strengthen against the US dollar, that tends to actually reduce inflationary pressures and vice versa. That's partly because a lot of the commodities which influence prices in South Africa, price inflation, are obviously priced in US dollars, whether that's the oil price, international petroleum product prices, and of course as well agricultural food prices. So all of these are quite key and are triggers for inflation as well in South Africa. But really coming back to the interest rate point that you looking at, as we said, what happens in the US matters. That expectations now been pushed back for an interest rate cut in the US to October, and that's probably going to give the rand a little bit of relief. But markets are watching around the world very closely in terms of what happens with US tariffs and, what's the impact really going to be in terms of US inflation. And, we did see some inflationary pressures come through recently in the US, particularly in PPI inflation. It caused expectations to pull back for the US hike to October. So if the US does cut its interest rates this year, or is expected to cut its interest rates this year, that could help us get a cut. But ultimately, Jeremy, what's really going to help us get interest rate cuts is for inflation to remain as close to 3% as possible. You might argue maybe we should have had cuts earlier in the year when inflation was obviously below 3%. And in fact, we did. We did have interest rate cuts at virtually every single meeting, but they were small cuts, so only 25 basis point cuts. Looking forwards, we think there's room to cut next year as well. And again, as I said, as inflation comes out perhaps below expectations, if it comes out below 4% over the remainder of this year and, obviously tries to run close to 3.5%, that would help on the interest rate cut front. But mostly next year, if we obviously see inflation grouping towards a 3% mark, again, that will help. I think also as well, we've seen very weak demand in South Africa, and that's also helped in terms of having very modest inflation. But overall, the Reserve Bank is going to mainly be driven by its inflation expectations. What does it think inflation is going to do in 12 to 18 months' time? And as you've seen from the revision of its recent forecasts, it's looking for that to be around 3%, and that on its own is probably going to see support for interest rate cuts.
Annabel, I want to come back to tariffs in just a moment that you raised, but let's talk about growth very quickly. Barely positive in Q1. September GDP release is fast approaching. So are there particular sectors that you might see as potential bright spots, and which structural drags are most likely to keep the growth rate anchored near that mark of 1%?
That's obviously a very key point for us, both in terms of inflation targeting, but overall as well. That 0.1% you noted for the first quarter of this year actually would have been minus 0.3%. So we would have lost 0.4% had it not been for a strong outperformance of the agricultural sector. Now, in the second quarter, we're expecting 0.5% GDP growth. Maybe it comes out at 0.4 or 0.6. We're expecting it to be around that mark. But once again, much depends on the agricultural sector. And of course, if economic growth comes out maybe closer to 0.8, 0.9 this year, or it comes out closer to 0.1, a lot can come as a consequence of very big movements in South Africa's agricultural sector. And we, of course, know that we're running through a very bad period of foot and mouth disease in South Africa, which is having a significant negative impact on the meat production industry. And of course, that's also having an impact on other areas as well. So that's one point to consider, that agriculture really does matter in our economy. But of course, as well, if we're looking at a situation where we consider, what could be the other key drivers, we do look at the industrial sector, for example, as something that's quite important. South Africa's industrial production sector, as around the world, is made up of mining, manufacturing, and of course, the electricity production sector. Now, while we've seen increased volumes, the value of South Africa's GDP is actually rand-based. It's not volume-based. And from that perspective, perspective, what happens in terms of prices of manufactured goods, electricity, but particularly mineral products are all very key to this process in terms of calculating GDP. So while we have seen, for example, a strong lift in mining production volumes in the second quarter, quarter-on-quarter seasonally adjusted, that really comes back to what did the mining prices do, metals and minerals, and they actually fell on the quarter. Now, of course, there's a third component that comes in, and that's when the Reserve Bank looks at turning the values into real terms, removing inflation. So all of these three factors, as you can see, can have a moving part. The fact that we've seen good volumes in industrial productions, but a negative impact from pricing and also from the deflationary effect, that then can actually show that we might be closer to 0.1 in that perspective. We have other sectors to add, of course, as well, and that's the transport industry, again, seeing good volumes, but much depends on the pricing there. And, of course, we look at the services side of the economy. So overall, we think we're probably going to see support come through for South Africa's GDP from services. That's your retail sector, your finance, your real estate, and, of course, a number of other areas. But we can't take away from the fact that we could have a massive swing factor coming through from agriculture, and that has often been the case for these quarters. Even though agriculture is a very small sector of the economy, it has a very big impact because it has extremely large swings in production. So as we said, we're looking for close to about 0.5%. We might get closer to the 1% mark if agriculture outperforms. And of course, there are risks in that area, or obviously we could see lower again, depending on what happens in that space.
So the United States, and let's talk about the tariffs now, has imposed tariffs on certain South African exports. Annabel, at this stage, are you able to give us a sense of the scale of the impact and what it's going to do to our growth, our trade balance, and maybe broader economic sentiment and outlook?
What we see in South Africa is that out of our total exports, 7.5% go to the US. So you can see it's quite a small proportion. But interestingly, the calculation is that close to 40% of those actually are not having tariffs, particularly metals and minerals, goods that the US uses in terms of its production. So when we look at the remainder out of that component, and if we assume perhaps that the tariffs do have a direct, effect, they record an elasticity of 1, in other words, it impacts very substantially, then we could actually potentially see a takeoff 0.2% from GDP growth. However, as we have heard from the South African government, we are likely to see that they are expected to put some mitigating factors to help us. And even though we have already had tariffs on motor vehicles this year, for example, coming in at 25% since April, we haven't seen a full collapse in exports to the US in that regard. In other words, no vehicle exports. They're down about 85%. So that means your elasticity is actually not 1. You actually are getting some exports through. So you can see there's a number of mitigating factors, and we could really maybe see 0.1 to 0.2% taken off economic growth. And of course, we're in August now, so that's not going to be, the case for this year because we are not having a full year of effect of these tariffs. But of course, certainly from next year, the risk is that we see that 0.2% taken off, but much will depend in terms of what other markets we can find around the world for our goods. And, the good news as well is that on the motor vehicle front, while we have actually seen this drop since April in terms of exports to the US, we've actually seen a rise overall in exports of motor vehicles around the world. And again, both of these are year-on-year comparisons. So that means there has been some substitution already into international markets. So I don't think we need to get excessively concerned from a macro perspective, but I think from a micro perspective in terms of what happens to industries in South Africa and what happens to jobs, that's a concern. And here we really wanted to bring in the second component of the longer term effect. So what happens in terms of companies that are operating in South Africa, international companies like Daimler Chrysler, for example, who might look to move their operations elsewhere, particularly in the US, which is looking to give them big incentives for production of motor vehicles there. So you can see, there's really short, medium and longer term effects. And of course, that really then would have a very negative impact on job creation and of course, existing jobs, particularly in the Eastern Cape. And that is a big concern for the South African economy. We really can't afford to see more job losses.
So against that backdrop, how resilient, Annabel, is the South African consumer right now? Where's the greatest pressure on household spending?
So the South African consumer has been battling for quite a while. We still see evidence of financial market vulnerability when we look at the many different surveys. And consumers, yes, they benefited a bit from lower interest rates. Of course, they are only 0.25% each time they cut. But nevertheless, a cut at virtually every single MPC meeting this year. And indeed, since November last year, we've only missed one where we didn't have a cut. Of course, as well, real incomes is a really important part of this equation. And what that means is, are consumers earning more in real terms when inflation's taken out, or are they actually earning less? And unfortunately, in the second half of this year, there's been a strong evidence that there has been a drop in real income. So that's a concern, obviously, for GDP growth in that quarter as well. But of course, overall, we do tend to see that there has been some improvement in some areas and other areas where we've seen some difficulty. I think if we actually have a look in terms of the retail sector itself, if we have a look at the second quarter, retail sales lifted by 0.9%, for example, but wholesale trade sales then fell by 0.4%. Now, of course, you have many other factors that go into that sector as well, such as tourism and, of course, motor vehicle sales. But the consumer seems to be really treading water in that regard, possibly seeing a bit of improvement, but we're not expecting to see it being a very strong growth quarter from household consumption expenditure on its own. And I think, overall, we're really going to see mixed results for Q2 this year for GDP.
We're going to continue this conversation in just a moment, but first a quick note about another Investec podcast you might enjoy. It's called Everything Counts, a bi-weekly series hosted by 702's Moteo Khoripe, and each episode dives into the essentials of personal finance, from smart saving and savvy spending to investment strategies, pitfalls to avoid, and tricks to succeed. Everything Counts offers practical tips and expert insights to help you take control of your money and your future. Search for Everything Counts wherever you get your podcasts, because when it comes to your financial well-being, everything truly does count. Now let's return to our conversation. And Annabel Bishop, a little earlier you referenced the currency. The rand has found support from recent dollar weakness, but how much of the strength, in your opinion, is simply global sentiment, and how much reflects genuine improvement in our economic fundamentals?
So that's an interesting question, partly because we often look at the rand as how its performance occurs against the US dollar, and not of the rand with its performance against other currencies. And if we actually have a look at the rand, we've seen that there has been some quite significant strength against the US dollar. But if we actually take out the weakness of the US dollar, then that tends to really bring it back to around its performance against other currencies. And that's the key point here. So rather looking at the rand on a wider basis, we feel there's been rand strength this year because against the dollar, it's moved towards 17.50, maybe, a little bit of volatility towards the 17.60 mark, but certainly not at the 18 rand the US dollar market was earlier this year, or 18.50. We can remember 19 and 20 rand to the US dollar. So all of that makes us feel that the rand is, significantly stronger. But as I said, when we take out dollar weakness, which is the other side of the equation, which has driven the rand's performance against the dollar, we look at the rand instead against the euro, against the pound, and even on a nominal trade-weighted basis, where we compare it to all our trading partners, the rand has seen significantly less strength. And this is quite important for us to bear in mind, that we can't necessarily see the rand's performance against the dollar only as an indication of what's happening in terms of South Africa and its economy, but rather instead look at it through the lens of how has it performed on its own, not in terms of, the dollar influence. The rand itself, and here we look at it just in terms of the short period that we've really been through this month compared to last month, and it's only really about 0.5% stronger against the euro and the UK pound. So it's subdued, but not unusual monthly currency movements that we've really seen. The rand, in other words, is not really reflecting much about the South African economy. It's rather just sitting and waiting, as indeed most currencies and financial market assets around the world are, to see what really happens in the third quarter of this year in terms of tariffs and how that's going to affect US economic indicators, whether it's growth or inflation, and of course as well then the US Federal Reserve Bank decisions on monetary policy.
Now, Annabel, we're recording this episode on the evening of Monday, the 18th of August. How would you characterise current financial market sentiment towards South Africa? And is it grounded in confidence or merely riding on global risk-on momentum?
For emerging market currencies, it really does have a significant impact, the sentiment of global financial markets, whether they're in a risk-on or risk-off phase, whether they're experiencing risk-taking or risk aversion, for example. And of course, as a consequence of that, then you do really tend to see group moves. Some emerging market economies might see better performance in their financial assets or worse than others, but overall there is often that very significant effect. As we said, markets have been taking a wait-and-see attitude. They are obviously concerned about what is going to happen. That said, there's also been interims of different levels of risk-taking. What we really mean here is we've seen very strong performance in equities, both around the world and in South Africa, for example, on the fact that we did see perhaps less severity in terms of US tariffs applied in August than might have been feared in July, and certainly than was feared in April this year. So some countries obviously seeing differentiated tariffs to the other, but really what, the key point here has been is that from a US economy perspective, we've actually seen less harshness towards most of its major trade partners. And that, of course, includes China, particularly here. And that is, again, in order to not have a very detrimental or devastating impact on the US economy. So obviously the Eurozone, the UK, and of course, as we're in countries, but particularly China, are very important trade partners for the United States. And of course, here we look at Brazil, we look at what's happening in Canada, Mexico, many different countries. But on the whole, and obviously there are a few outliers here, we've seen the US be cautious in this regard. And what that really means is that, markets have then gained in relief. So you've had periods of market having a negative reaction and then a positive reaction as things haven't turned out quite as bad as they could have been. Things are still worse than they were in the first quarter of this year, for example, from a tariff perspective. But really now, with them coming into effect, there's been some relief that they're not quite as harsh as they may have been. That then would not have as serious an impact on the US economy as may well have been the case. It doesn't mean that economic indicators aren't flashing some red lights. And we see that recently from producer price inflation in the US. There's obviously been movements as well in terms of inventory stocking and trade and many different areas where the US industry has been trying to prepare itself for incoming tariffs. That's also caused volatility as well. But overall, we really are seeing a wait-and-see approach. I think, delving then down from that into South Africa, really tells us that markets are a bit cautious, but they've obviously also then, in the interim, we've seen some significant lift in equities. We've actually seen that in periods throughout this year. And that, of course, benefits our financial markets as well. So I would say that's really riding more on the international environment than South Africa specific. In South Africa itself, I think investors still want to see that we're going to experience substantially stronger economic growth, but also, of course, as well would like to see inflation coalescing more permanently at 3%. That could also be helpful. But I think particularly as well, there is some concern about the politics in South Africa still, not necessarily, from the US's perspective, but, over the past few years, there's been worries about political risk, about the sustainability of the government of national unity. And obviously, as we now move towards the municipal elections, there'll be scrutiny from that perspective as well. So overall, I think that there has really been a situation where most of the market focus has been on the US, its trade policies, its foreign policies, and really trying to draw out what that's going to really mean for the rest of the year. Markets do expect to see the US pull back if things become quite negative for its economy, if we get very negative readings. But there's also been worries, as you know, around the Federal Reserve Bank in the US, comments from the president of the US saying that he wishes to replace the chairman of the Fed, really trying to coerce lower interest rates in that environment. So overall, there has been some concern then that, might need to see perhaps some moderation in tariffs if the economy really starts to weaken, and if the Fed holds its line, if it doesn't move into lower interest rates, it might even move into higher interest rates if we see inflation come through as well. So quite a lot to look at, Jeremy, but really, what investors want to see is a much stronger growth path for South Africa.
So, Annabel, as we bring this conversation to a close, let me just ask you, what key economic indicators will you be tracking most closely in coming months? And what do you see as the single greatest external threat to our macroeconomic stability?
We do worry a bit about government finances. We have seen that there's been a deterioration, a very strong deterioration in South Africa's government finances over the last decade, and obviously through this decade as well, with the debt to GDP ratio closer to 80%. But there's concerns as well that, once you include the money owed to state-owned entities, the debt that's guaranteed by our government, they'll repay the debt of SOEs if they're unable to do so. And in fact, we've seen a lot of money flowing into the SOEs for that purpose. There's worry as well that the ratio then starts to rise above the 80% mark. And of course, for investors as well, there's then concern around South Africa's Investec bond market. A lower inflation target, in other words, when inflation is sustainably around 3% and interest rates fall substantially in South Africa, hopefully the repo rate moves down to the 6 to 5.5% mark, then that really does mean that there'll be some benefit to bonds. I think perhaps investors are seeing a bit of a wait-and-see approach again on our domestic bond market. There has obviously been a small improvement, maybe around 20 basis points since the Reserve Bank's announcement that it would like to look at inflation now at 3%. As opposed to 4.5%. So we do look what is happening in South Africa's fiscal policy and its monetary policy. Do the two dovetail? Is it supportive there? Because we obviously have seen increases really being built in for government finances closer to the 4 to 4.5% mark from an expenditure perspective. And that's obviously well above the 3% mark for inflation. So all of these factors, do start to have an impact in terms of the sustainability of government finances. The reason why we bring this up, Jeremy, is that the point really for emerging markets is that their debt to GDP ratio should be at 60% or below for sustainability. As we said, ours is approaching around the 80% mark. So that's one area we do tend to focus on, what's happening with government debt. We know that it's very tight. They can't spend a lot. And that then brings us to the second point, what's happening in terms of our transport system expenditure in Transnet, and of course as well, improvements in the ports. That's another key area which we tend to watch very closely. And there has been some volume improvement there, but it hasn't resolved the freight crisis. So we're very far from looking at a 3% GDP growth rate. At most, we could see GDP growth starting to approach 1% this quarter. But again, much depends on the agricultural sector. Of course, as well, we do look at what's happening with the Reserve Bank. But overall, I think, we're really going to start to see how the impact of the US tariffs comes through, possibly in the main from next year. And that's something we're going to be looking at quite closely as well. From a confidence perspective, it remains very depressed. Business confidence remains below 50. People look at business confidence lifting and falling, but that's not really the right thing to do. If your business confidence is depressed territory, it's not essentially seeing business confidence lift. You're seeing business confidence become less depressed. And, that is something which gives us a sense that we're not going to be running a particularly strong economic growth in the second or even the third quarter. Why that is that business confidence is actually a measure of profitability. It's not a measure of future expectations. It's a measure of saying, are businesses satisfied with current operating conditions? And if the majority of businesses are saying they're not, they're below the 50% mark, then that really tells you that you're not in an optimistic environment. So that's really where we do still find ourselves business confidence. And that's why that's another area that we're looking at quite closely. Businesses might become less depressed. There may be fewer businesses who say that they are not experiencing poor conditions, operating conditions, but that's not the majority of businesses. There's still more businesses who are experiencing poor operating conditions than those who are experiencing satisfactory conditions. So these are all factors that we do take into the mix for South Africa. We do think that, we're focusing very much on the short term here, on quarterly movements of first, the second, the third quarter, rather looking at over a 5-year perspective. And if we look at, where's economic growth expected to go, then we'd be looking at the 3% mark. And that's particularly on, as we said earlier, the strong improvement in the transport sector. And that, of course, then would feed through into improvement in economic growth in other areas as well. So perhaps, Jeremy, we look at 2025 as a moderate to weak economic growth here. And we really start to expect to see improvements going forwards over the next several years, really moving out to 2030 when we are expecting to see economic growth run at 3% instead of around 0.5%.
Annabel Bishop is Investec's chief economist. Annabel, thank you so much for joining me on this edition of No Ordinary Wednesday.
It's a pleasure, Jeremy.
If you enjoyed this conversation, follow Investec Focus Radio SA wherever you get your podcasts. We'll be back in 2 weeks with more on how the world's big shifts are shaping how we live, invest and lead. Until then, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.